Hello everyone, welcome to the next lecture wherein we will continue with net income and we will arrive at comprehensive income. We will discuss what are OCI items and then we will move on to statement of changes in equity. So that's the agenda for today's lecture. Now as you remember, in the last lecture we had calculated till net income, right? And now we move on to OCI, other comprehensive income. Now this is a pretty unique concept which is there in GAAP. Now it's also being adopted in Ind AS but not in the exact same manner, right? So when you look at comprehensive income, it's basically a summation of net income and OCI, other comprehensive income. If you see here, what we are saying is all changes in equity except owner transaction. So any transactions which are related to the owner, we don't take it to net income, right? We park it in OCI. OCI is known as a parking lot, right? At times, certain line items are parked there for the time being. At times, they are there forever, right? So we will deep dive into OCI line items in study unit 4, but for now we will just list out what are the line items in OCI, what are the components of OCI. Now one thing which you should know here is when we look at a multi-step income statement, right? Let's look at a multi-step income statement. Now what we have calculated at this point is this one, income from operations. Here we have separately calculated income tax expense and right, income before taxes, and then we calculated income tax expense. Now in case there is discontinued operations, all the line items after the income from continued operations, we call it as income from continued operations, right? Income from operations. After this line items, all the other line items are presented net of tax. So when we look at OCI, right, when we start with OCI discussion, still this concept continues that all the line items of OCI have to be presented net of tax, right? When I say net of tax, it is gross minus tax, and this is the net item that we are talking about. So these are the items that are presented, right? We are not going to present a gross figure and then we calculate the tax separately and then in the outer column display this. This is not how we present in GAAP income statement. We will present the items net of tax, right? So what are the components of net income? We've discussed in the earlier lecture. It is revenue, expenses, gains and losses. All these items are treated in the income statement, right? And eventually close to retained earnings. So this is how we look at, this is the net income calculation, right? This is the, let's say this is income statement, and when we move on to balance sheet, under equity retained earnings, this net income item goes, right? When we look into OCI, other comprehensive income, right? So what we are saying is it is income but some kind of other income, right? If you look at this, unrealized gains and losses on available for sale debt securities, right? Debt securities are investment in bonds basically. Available for sale is, let's say when we discuss the available for sale, we need to understand what is available for trading and what is held till maturity securities. So available for trading, or simply put, trading securities are those securities in which the company wants to make a short-term profit, sell the security and book the profit, right? The time horizon here is less than an year. When we look into held till maturity securities, here the company wants to hold the security till maturity. Let's say if a 10-year bond is issued, the company has purchased that bond, company will stay invested for 10 years. That's your held till maturity security. This one is less than 1 year. Now any security which the company has and it does not fit these two criteria, we call it as available for sale security, and right now we are talking about debt security, which is bonds, etc. Now second option is cash flow hedge gains and losses. Now hedges we will again cover in detail when we move on to other chapters, but for now just understand that a company is trying to deal in derivatives so that at a future point of time, or rather for a future period of time, the company pays a stable cash flow. Right, let's say for purchases, etc., raw material purchases and all, it has come into contract with some seller, right, some vendor. That vendor may be within the country or maybe outside the country, but the company has struck a contract with that vendor to provide raw materials at a stable rate, right? That's a cash flow hedge. Cash flow hedge, gains and losses, again parked under OCI. Foreign currency translation. Now this is a concept relevant for consolidation, right? When a parent consolidates the subsidiary financials, there can be certain fluctuations in foreign exchange in case the subsidiary is based out of different country or a foreign country. So let's say there is a sale transaction which took place, but when you convert that sale transaction into a different currency, it can lead to some gain or loss. So that loss is parked under foreign currency translation. Then you have instrument specific credit risk, right? So let's discuss these line items as and when they occur for us, right? They are all accumulated to OCI. So now we have a line item here. So let's say we added OCI items here, which allowed us to move on to comprehensive income. This comprehensive income, or rather just the OCI component, moves to accumulated OCI. Year on year basis, this keeps on getting added to accumulated OCI. If it's a net income figure, gain figure, it's added. If it's a net loss figure, it gets deducted, right? So net income gets added to retained earnings, and OCI items, total of OCI, gets added to accumulated OCI, right? Presentation is also separate in the balance sheet so that we maintain the owner transactions and non-owner transactions in the balance sheet also. Right. Now moving on to options for reporting. What are the different option companies get? Now as we have seen, GAAP is pretty lenient in terms of how the companies are presenting their financials, right? So when we look into the presentation option, we have got one option, or option A, wherein it's presented as single statement. So you start with revenues. We start with revenues figure over here, and we calculate net income, then we calculate OCI, and then finally we arrive at comprehensive income. One single statement. The other one is two statements. So wherein in one statement we calculate till net income, second statement we adjust OCI to net income and get comprehensive income, right? Both the options are right. Both the options are correct. Companies can select any option which works fine with them, right? So this is one single statement presentation. We started from revenues. Here we calculated net income and we made the adjustments. Foreign currency translation adjustment, unrealized holding gains, minus reclassification from OCI in case there is any readjustment. Some line item moves from OCI to net income or vice versa, that reclassification we do, and then loss on cash flow hedge, which gives us other comprehensive income. This is total of OCI, which helps us create comprehensive income, right? So this is the one single statement presentation, right? Separate statement is, presentation is, you stop here at net income and again start with net income and show this separately, right? Now you need not take a lot of tension for OCI calculation. All these terms might come across as very intimidating, but believe me, as and when we take each line item of OCI one by one, as and when we cover different chapters, you will all start to understand the treatment very effectively and very beautifully, and it will all tie in the end for you. So let's look into the mnemonic. So what I have done is I have worked on a mnemonic which you can use to help memorize the components of OCI. Right? So the mnemonic goes by the name of PACE, P-A-C-E, right? Wherein PACE, P stands for pension adjustment, right? So mostly whatever the pension instruments etc. the company invests in, that appreciation or depreciation in the pension value is never owned by company, right? Because pension is something which will be paid to the employees eventually. So pension adjustment, in case the fund is appreciated or depreciated, it should not affect net income, and that's why any adjustment to pension is parked under OCI. Accrual gains or losses, right, we park it under OCI. Now available for sale debt securities, this we have discussed. Any unrealized holding gains or losses. What is meant by unrealized is, let's say you purchase something for $20 at the beginning of the year. At the end of the year, the security is valued at $30. Now you have not sold the security, right? And when we are talking about debt security, so let's say we are talking about bond. So we have not yet sold the security, but this $10 profit, which is company unrealized gain, will park it under A of your mnemonic PACE, available for sale debt securities, unrealized holding gains and losses. Now when we move on to C, we discuss this in short. Currency translation under consolidation. If there is any fluctuation in foreign currency rates of the parent with the subsidiary during the year, any gain or loss is parked under C of the mnemonic for OCI, right? Last one is effective portion of cash flow hedge. Now, what is the nuanced understanding of effective portion? What is exactly cash flow hedge? We will cover in the upcoming chapters. The understanding which you have as of now is sufficient for understanding comprehensive income, right? So, it is the effective portion of cash flow hedge, which is basically hedging the cash flow of a company, right? Now, there is one fifth element which is also there, but it is very rarely tested in the examination. It is changes in fair value from instrument specific credit risk on liabilities where the fair value option is elected. As of now, just know that, hey, this is a line item. As and when the time comes, we will discuss this line item in detail, right? So, for now, we know that from net income, we do the adjustment for OCI, which helps us arrive at comprehensive income, right? The line item over here, this 135,000. Usually it is in millions. The companies don't present the similar zeros, they'll just present the major numbers, right? So this net income 110, this goes into retained earnings. This OCI, other comprehensive income, goes to accumulated OCI in balance sheet. Now let's quickly do a knowledge check question, right? Unrealized holding gains on available for sale debt securities are reported in net income, other comprehensive income, retained earnings directly, and revenue. So this question this concept we just discussed. So other comprehensive income is the correct option, right? Now, if I have to discuss what kind of questions gets tested in the CPA examination, though I will be doing a standalone session on the examination pattern. For now, you should know that there are MCQs and simulations which are tested in the examination, right? And it could be that many of you who are watching my video, you might be a CA already, or you may be pursuing CA, or you may have cleared your IPCC, and let's say, God forbid, you couldn't pursue it later on for many reasons, right? And CPA is the qualification that you now want to target, which will obviously make you qualified, right? So since I am a CPA, I have given my examination, and by God's grace, I could clear all my examination in one go. So, and being in the education field for the last 10 years, teaching CPA and CMA, interacting with the professionals, and looking into 10,000, 20,000 plus questions so far, right? I have a good understanding of how the questions look like in the examination. And believe me, CPA questions are very straightforward. They are pretty straightforward and they are not very twisted, right? For example, CMA questions are difficult to understand, right? I have given both CMA examinations. I'm both a CPA and a CMA, right? So I know how examination questions differ between CPA and CMA. Right, so your CMA examination questions, MCQs, are very verbose, they are very elaborate, they give you a lot of data, and they are pretty difficult to understand and eventually solve, right? For that also you need a knack to be able to solve those questions in short span of time, right? But when I look at CPA questions are pretty straightforward. Very rarely they will throw a twist in the questions, in case you know the concepts, right? So now for CPA, the concept is content is too vast, right? With a vast content, they have a shallow testing, right? For CMA, the content is not as vast, but the testing is pretty detailed. So one change or one good thing which you could say with CPA is you need to know a wide variety of concepts, but not a deep dive on each of those concepts. And again, hence the questions, MCQs, are pretty straightforward, right? Simulations are something wherein you will have to use a lot of your brain cells, but in MCQs, they are pretty straightforward, easy to solve. And these kind of MCQs which I am kind of taking, they are more or less of a knowledge check MCQs, right? They are not very detailed MCQs, but you can very well expect few such questions in the examinations which are straightforward, right? They are just knowledge based MCQs. They are just checking for your knowledge, and you can expect such kind of question. This is a little more basic than what you would expect in the examination, but still it gives you a flavor of how the testing is done in the examination, right? Moving forward to the statement of changes in equity, right? Now this is a very simple statement. So what we are doing over here is we are mapping the changes in opening equity of last year, let's say this is 2024 to 2025, right? So if the amount has moved from this year to this year, what are the reasons, what are the line items due to which the amounts have moved? So we are kind of doing a mapping exercise, right? So we are mapping that last year's items were these, this year items are these, what are the amounts that has moved, right? So when you look at the format of the statement, you will pretty well understand. Now what we are doing is, this is again a required disclosure as per SEC, that you need to map the changes in your equity from last year to this year, and hence we create the statement of changes in equity. Now when you look at the line items which are there, what is it that we are tracking, right? So we are tracking changes in retained earnings, we are tracking changes in accumulated OCI, common stock, preferred stock, additional paid in capital, non-controlling interest, and treasury stock. Now I'm sure you all know these four options, these four concepts. When we look at additional paid in capital, this might be a new term for you, but it's pretty easy and simple. It's simply the premium, the share premium amount, right? So in case a $10 share is sold for $12, remaining this $2 is premium, right? And it is parked under additional paid in capital. $10 will go to common stock, right? And $2 is parked under EPIC, or simply put premium. In GAAP terminology, we call it as EPIC, additional paid in capital. Now when we look into non-controlling interest, this is a line item relevant to parent organization, right? When consolidation is done of all the subsidiaries of the parent, 100% consolidation is done, right? So it could be the case that in one company, the parent organization owns 70%. It could be the case that in other subsidiary, the parent organization holds 90%. Now when we consolidate the income statement and balance sheet line items, 100% consolidation for both subsidiaries is done, So it's not that we will take 70% of revenue, we'll take 90% of revenue. We don't do that, right? We will take 100% of whatever subsidiaries revenues is there and all other line items. That will be consolidated into parents line items of income statement, and same goes for balance sheet. Now this remaining portion of 70% here, this remaining portion of 10% here, 30% and 10% here, it is parked under non-controlling interest again in the balance sheet. Non-controlling interest, non-controlling interest. Now, because this is relevant for parent, only consolidated balance sheet will have a non-controlling interest, and an individual standalone company's balance sheet will not have this item. Right? When we look into treasury stock, you must have heard the term of share buyback. Right? In Ind AS, or even if you have done your accounting, your graduation in IFRS, this term is known as buyback, right? So let's say the company buys back its own shares from the market, right? This is presented as a deduction of the outstanding stock, right? Treasury stock, share buyback. So these are the three items which are kind of different in terminology. They are not unique to GAAP, but terminology may be different to what you might be used to. So EPIC, NCI and treasury stock, right? And what we are doing is we are checking for all the additions. What can be the additions during the year? Obviously net income, right? There can be prior period adjustments. Let's say there was some error or some change in accounting policy, anything could be the case. Because of that, some adjustments are there. So those adjustments will impact your retained earnings, right? Again, net income will also impact retained earnings. Reissuance of treasury stock, right? So there are two different methods of treasury stock calculation. In accounting, which you are used to in Indian accounting, the share bought back is extinguished. It is not reissued. But in GAAP, the treasury stock, as we call it, is reissued mostly at the times of mergers, acquisitions, etc., to pay off the other company, right? So the reissue of treasury stock is very common, right? The cost method of reissue of treasury stock again will impact the overall addition in your statement of changes in equity, and net loss will reduce it. Dividends declared, it will reduce the retained earnings, and any appropriation, let's say a sinking fund for bond, etc., has been created, that will reduce the overall equity portion. Right? Now looking into a sample table. This is a sample statement of changes in equity. We have total equity, this is the total. Then we have retained earnings, accumulated OCI, common stock, EPIC and treasury stock. Treasury stock, obviously you see, is a minus figure, right? Minus 20, minus 15, the company purchased more of its own stock from the market. Minus 15, total is minus 35. EPIC, additional paid in capital. 30 was opening, the company issued new stock. It collected 80,000 million or whatever of EPIC, total is 110. 40, that was common stock opening, 10 new. So if you see, the company issued the shares at a high amount of premium, right? 40, 10, total 50. Accumulated OCI was 100. Company added 25 more, total is 125. Here retained earnings 350, new net income, fresh net income added 110, dividends declared, right? So I don't know if you have that confusion or not, but you should know that dividends which are declared are always declared after the net income gets added to retained earnings. It's not the other way around. Even in income statement, you will not find dividends amount mentioned against net income. It is retained earnings minus dividend always, right? So dividends declared minus 60, total 400. And this is a total of all the events that have taken place during the year, right? Total of everything. This is the total equity. Beginning balance is 500, closing balance is 650. So what we have essentially done is we have mapped how this 500 opening arrived at 650 closing, right? That's what we have basically done. Let's take a quick question. Which of the following would increase retained earnings, right? Which event increases retained earnings? So dividend declared, we saw that it will reduce the retained earnings because it's a declaration, it's a outflow for the company, it will reduce the retained earnings. Net loss, again it will reduce, right? So this is retained earnings minus dividend minus loss, right? Net income for the period, so this is always added, right? Net income for the period. Repurchase of common stock. So repurchase of common stock is nothing but treasury stock, right? So we have common stock and treasury stock is a minus figure, so it will reduce it. This will also reduce, this will also reduce, only this will increase. So net income for the period. Let's check which is correct. Net income for the period increases the retained earnings for the company, right? Now, a quick recap of certain non-GAAP basis of accounting, right? So when an annual report is issued, it's basically issued using GAAP, right? That's what is acceptable in the US. Now, for the last few years, the SEC has also started to accept IFRS based financials when they are issued, right? So there was this one GAAP and IFRS consolidation or streamlining exercise which went on for a good many years during the early 2010s. From the late 2000 to the early 2010, there was this endeavor to streamline the policies of GAAP with the policies of IFRS. With that, certain changes in revenue recognition, leases, etc. were done, R&D, treatment, etc. Now, with that, there was this one line item of extraordinary and infrequent in GAAP income statement, which was done away with, right? So now we just look into non-operating line items. We don't look into extraordinary and infrequent. That was a classification GAAP had, which IFRS did not have. So under this project of their streamlining, GAAP did away with this separate classification of extraordinary and infrequent items, right? So we don't have it anymore. So again, so many different changes came in, and like I said, GAAP and IFRS are the acceptable formats of reporting under US. Now there are certain other basis of accounting which is also accepted for certain specific uses, not for financial reporting purposes, but for certain specific uses. Let's say a small organization, let's say entrepreneur based company, or a just one man company, that company can use cash basis for its a small trader is there, the small trader can use a cash basis for their financials, right? They don't have to use accrual basis. Modified cash basis, so for certain transactions you use accrual basis of classification. Let's say for inventory, for accrued taxes and all, you use accrual basis, but for sales and expenses and all that, you use still cash basis. So that is a modified cash basis of financials. Common for professional service firms, right? This one is common for sole proprietorships, right? Smaller organizations, they can record their books of accounts using cash basis. Third one is income tax basis. Now the Internal Revenue Service Department in the US, which is IRS, equivalent to income tax department in India, right? So IRS asks for certain different application of principles as compared to GAAP, right? And if you are calculating the tax to be payable to IRS, the taxation has to be calculated using the tax basis, right? So we usually say that, you know, there is GAAP basis books and there are tax basis books. So tax basis books, there's very different treatment. Let's say for any provision, etc. GAAP tax books, which is IRS, it does not accept provisions, right? Provisions for bad debt, provision for warranty, etc. as an expenditure till that loss has not occurred, right? So till the bad debt has not occurred, or till the company has not paid its warranty expenses, etc., till that time you cannot deduct that, right? And again, for depreciation methods, there are certain other different depreciation methods which IRS allows, right? Let's say, for example, makers, right? Modified accelerated cost recovery system. This is something which IRS allows and GAAP does not allow, right? So there are certain differences in the treatment of line items which makes the tax different as per the tax book as compared to the GAAP book. So income tax basis is accepted by IRS. Then you have regulatory basis. If you are in a very different industry wherein regulation requires you to create financial basis, that basis, it's a separate set of financials which is regulatory basis, used to comply with a separate specific regulators requirement. Let's say you are in the banking industry, you are in the insurance industry, different set of financials, or rather very similar sounding financials but with a different treatment of various line items is accepted, right? So you have 4 major categories of transactions which are also created: cash basis, modified basis, income tax basis, and regulatory basis, right? Now for this modified cash basis, let's understand how can you convert the different line items into modified cash basis. Now, for example, the company wants to calculate cash collected from customers. This one, right? Even for that matter, if a sole proprietorship wants to calculate cash collected from customers basis the other information that they have, right? So what we have to do is we have to look into beginning inventory. So here we have obviously receivables, beginning AR plus sales equals ending AR. So it's pretty simple, right? Beginning plus new sales should equal ending and cash collected. That's the simple ledger format. In GAAP, we call this as a T account, right? Same goes for cash paid to suppliers. Now this is an expense, right? This is an income and this is an expense. Right? That's how you can calculate cash paid to suppliers. Interest paid, beginning interest payable plus interest expense minus ending interest payable. Just look at it as a equation, right? Beginning interest payable, which is beginning liability, plus new interest expense will equal interest paid plus interest ending or outstanding, right? This is a simple equation. You have 3 components of the equation. You want to calculate the 4th one, right? I'll show a couple of T accounts which will help you understand the flow of items from one line item to the other. So a sample T account for calculating cash collected from customer, right? We look into accounts receivable, we have beginning balance, to that we add sales, and from that you will have the cash collected which will eventually give you ending balance. So this is the equation that we are looking at, right? Beginning AR plus sales minus ending AR equals to cash collected. Now a sample for liability, which is interest paid. Let's see how you can calculate. We are creating a T account ledger, right? So we'll have credit balance, beginning balance plus the new interest which is accrued. Let's say for bond, etc. Some interest is accrued for the year. There is some beginning balance for interest which is to be paid yet, and then this difference, this plus this minus this, will give you this. So interest beginning payable plus expense minus payable gives you interest paid. So the way I will suggest is, you don't have to always create a T account, but if in your mind this image is readily recollectable, what you can do is you won't have to remember this, right? And I always suggest that always look at images, try and post that to your memory, and with this you can always recreate this, right? In case you are trying to memorize, it might become too much because there's so many things that you need to be able to memorize and recollect. So the idea is that we try and look at images, try and recollect that image whenever you want to revisit or you want to solve a question. Just recollect this image in your mind and then try to find out how to do the calculation. It really works 200% of the times. Take it from me, I've cleared all these examinations, right? So let's quickly solve for one MCQ here. Which basis of accounting is required for preparing a tax return? We have cash basis, modified cash basis, income tax basis, and regulatory basis. Needless to say, it is income tax basis, right? Which is the correct option over here. That is all for the lecture today that we have. I will see you all in the next lecture, wherein I will take the financials of a listed company and we will go through the financials and try and understand how does the theoretical stuff ties in with the practical things. So look out for my next video wherein we do this analysis. Till then, stay safe, stay healthy.